Before we begin, a quick disclaimer. I am not a financial advisor and this video is for education and entertainment only. Nothing here is investment, tax, or legal advice, and nothing is a recommendation to buy or sell any security. Investing involves risk, including the loss of your capital. Past performance does not guarantee future results. I may hold some of the assets discussed. Always do your own research and consult a licensed professional before making any decision. Imagine a fund advertising an 85% annual yield, not 8.5, 85. It sounds like free money, but over roughly a year, that same fund saw its share price collapse by about 70%. Investors were handed huge monthly payments and watched their capital quietly disappear at the same time. This is the trap at the heart of the highest yielding funds on the market. And by the end of this video, you will be able to spot it in any fund in about 60 seconds. First, the basics. NAV stands for net asset value. It is simply the value of everything the fund owns, divided by the number of shares. Think of it as the true worth of one share. When you hear that a fund's price is eroding, what people usually mean is that this net asset value is drifting lower and lower over time. But here is the subtlety that almost every clickbait video gets wrong. Not all NAV decline is erosion. Let me show you the difference, because it is the whole game. When a fund pays you a distribution, the cash comes out of the fund's assets. So on the day it pays, the NAV mechanically drops by exactly that amount. That is not a loss. That is value moving from the fund's pocket into yours, like moving money from your left hand to your right. Your total wealth is unchanged. True erosion is something else entirely. True erosion is when the fund pays out more than its strategy actually earns. So it has to dip into your principal to fund the distribution month after month. One is harmless accounting, the other slowly destroys you. So here is the single question that cuts through every glossy marketing page. Where is the money actually coming from? If a fund yields 10% a year, but its share price falls 8%, it is not really paying you 10% of income. It is paying you back your own capital with an income label slapped on it. A high yield tells you how much cash is leaving the fund. It tells you nothing about whether that cash was actually earned. The technical name for being paid your own money back is return of capital, or ROC. On a fund's distribution breakdown, you will see how much of each payment came from income, from realized gains, and from return of capital. A small amount of return of capital is normal and sometimes even tax efficient. But when a large share of a fund's distribution is return of capital year after year, that is the fingerprint of a yield trap. It also has a sting in the tail at tax time, because return of capital lowers your cost basis, which can mean a bigger capital gains bill later. This is not theoretical. Let us look at what actually happened to some of the most extreme high-yield funds, because the numbers tell the story better than any explanation. Take one of the headline ultra-high yield funds. It advertised a distribution rate of around 85%. Extraordinary. But from early 2024 into 2025, its net asset value fell by nearly 70%. A huge chunk of those distributions was simply return of capital, handing investors their own money while the share price cratered beneath them. The yield was real on paper. The wealth destruction was real in the account. Now, to be fair and accurate, you have to judge these funds on total return, which combines the price change and the distributions together. Some high-income funds do post a positive total return even while their price erodes, especially if the underlying assets soared. One fund tied to a surging chip stock delivered strong total returns because the underlying rose so much. But another, tied to a volatile crypto-linked stock, captured only a fraction of the upside while its price fell roughly 2/3 from the peak. The lesson is not that yield is evil. It is that yield without total return is a mirage. Here is the illusion in plain numbers. Say you put $3,000 into a fund, buying 100 shares at $30. over the year it pays you about $4,000 in distributions. Amazing, right? Except the share price fell to $20, so your 100 shares are now worth 2,000. You received 4,000 in cash but lost 1,000 in value. Your real gain was about $3,020 on a $3,000 investment. That is a total return under 1% after a year of stomach-churning risk. The eye-popping yield delivered almost nothing. So how do you screen for this yourself before you put a cent in? Here is the 60-second checklist I promised you. 1. Look at total return over several years, not the yield. If total return badly trails a plain index, be suspicious. 2. Check the distribution breakdown for return of capital. A large, persistent share is a red flag. 3. Look at the long-term price chart. Is the NAV steadily grinding lower or holding its ground? 4. Ask whether the payout has been shrinking in dollar terms, which signals the strategy cannot keep up. And 5. Sanity check the fee, because a high expense ratio on top of erosion is a double drain. And to keep this honest, a high-yield NAV declining fund is not always a mistake. If you genuinely need monthly cash now, if you are spending the income rather than trying to compound it, and if you have sized the position as a small sleeve rather than your core, these funds can do a real job. The danger is only when someone buys them for the headline yield, expecting both the income and the growth, and oversizes the position. That is how people get forced to sell at the worst possible time. To wrap up, a distribution that simply moves value into your pocket is fine. A distribution funded by quietly returning your own capital is a trap. The only honest scoreboard is total return, and the one question that protects you is, where is the money coming from? Ask it every time, run the checklist, and no glossy yield number will ever fool you again. None of this is a recommendation about any specific fund. That is for you to research. If this made yield traps click into place, consider subscribing, and as always, protect your downside first. Thanks for watching.